afternoon, everyone. I want to let you know we're getting close to the end of our tax update. I hope you've enjoyed what's gone on so far. My name is Celia Langford, and we're going to be talking about Grantor Trust this afternoon. A couple of housekeeping items before we start. If you will go ahead and open the feedback survey, you'll be able to drop in the code words along the way. There will be 3 of them, and you will need those to have your CPE. As is mentioned before in other sessions, these sessions are being recorded for future reference. Your participation indicates your consent for your voice or your image to be part of the recording. Please do not disclose any private information during the sessions. Thanks so much. So I want to welcome everyone for joining me to learn about trust today, especially the mysterious world of Grantor Trust. In general, the world of trust taxation can be very confusing, but I hope that by the end of this session, we will be at least a little less confused. As we go through the material, I will try to incorporate a few examples so that we will have some context.
Let's see. She said, so I want to let you know I did not further revise the no compete provision because after
Needs to mute the
Robin, your mic's on.
Thank you. All right. As our agenda today includes a general overview of what trusts are, because I think really we can all review it, and there's some features that we all need to know about trust. We will spend a little bit of time talking about revocable trust versus irrevocable trust. And then we are going to go on into the unique features of Grantor Trust, as well as some of the tax reporting features for Grantor Trust. And then finally, there's not a lot that's new. It could have been, but we'll talk about that at the end. And I will give you a few resources, especially if you want to learn more about trust and trust taxation. To begin, let's start with a general overview of trust. It's useful to think of trust as part of an overall estate plan. So I'd like for us to start by thinking of some of the reasons why an estate plan is needed. Sometimes they are, sometimes the prevailing laws apply and you don't really need to worry about your estate, but in most of our clients' cases, there are estate issues that they need to deal with. Family relationships often involve complicated emotions, and while we often think of estate planning as applying only to the wealthy, there are often non-tax considerations which are also addressed effectively through thoughtful estate planning. Certainly, earned and inherited wealth are the strong motivators for estate planning, especially if you inherit assets such as stock with a low basis that's appreciated over time, and you want to be able to avoid some tax as you go forward or trying to get it to the next generation. Another thing to think about is if you've had a family business or some property in your family that's been held for a long time, those family-owned businesses sometimes earn a lot of money, or sometimes they just have an emotional tie to you, and you want to make sure they're available for the next generation. So that kind of combines the emotional and the financial aspects of estate planning. One factor is also having family members who have special needs, who could be vulnerable without some financial protection. Those are also good reasons for us to think about estate and estate planning. So we're going to look at some of the reasons next of why estate planning isn't just accomplished with a will, and why trusts are an effective part of estate planning. If you just have a will, there's 2 key features to be aware of. First of all, if you have a will, processing that will when you die and making sure the assets are transferred according to the terms of your will becomes a matter of public record. And not everybody is comfortable with having all of their information be a matter of public record. Also, if you only transfer your assets through a will, then they're only going to be transferred at your death. You don't have any, you give up some planning opportunities. Certainly, it's useful, and there's some things that you only want to transfer at death. But if you incorporate trust also as part of your overall generational plan, there's two things that it's very useful for. First of all, you're going to avoid the public record and the probate process. The process is quite cumbersome for some states, and probate is subject to state law. So it's whatever happens in the jurisdiction where you live or where your property is that determines how involved your probate could be. And also with the trust, you have some control over the date of when those assets transfer and what the terms are. So let's move on into, now that we understand why trusts are important, let's go ahead and talk about the features of a trust. So I think it's most important for us to begin with what exactly is a trust. And at its core, a trust is a legal document, and it's a way to exercise control over when you transfer assets and how you transfer assets and to whom you transfer assets. So those three features really help. It is a fiduciary arrangement, however. So it allows a trustee to hold your assets and to manage your assets until those items are legally transferred to the intended recipient. Now, I've got three terms at the bottom of this slide, and I think it's important to note that these are three key components to a trust agreement. Two of them are kind of straightforward, and then we're going to spend a little more time on the third one. The grantor is the person who creates the trust. It's usually the person who funds the trust. That's pretty straightforward. It's the person who's basically making this happen. The beneficiary is the intended recipient. They could be a beneficiary for income. They could be beneficiary for the trust assets, which is usually called the principal or the corpus. But those are the people who are going to get benefit from it. The person in the middle, however, is really the key person that we want to focus on for a few minutes, and that's the trustee. That's the person that's been charged with the responsibility of managing those assets. So let's spend a little time on the trustee. The primary responsibilities of the trustee are the investment, administration, and distribution of the trust assets. Now, a trustee doesn't have to be an expert in all of those features. They can hire an investment advisor. They can hire accountants to help them deal with the tax issues. But the trustee has the responsibility of overseeing the management of the trust assets. And the trustee must consent to the position. It's not like you can just name a trustee in your trust and, oh, they don't have to consent. That trustee is required to consent to it, and once they accept being the trustee, they cannot resign unless there is consent of the beneficiaries or of the court. The trustee has a fiduciary standard of conduct. Trusts are governed by the trust document, and they also are governed by the jurisdiction where they are drafted. And we're going to talk a little bit more about that, but just be aware that the trust document is a very important document. That's why you want to make sure that whoever drafts that document understands the implications of what they're writing. That's right. Getting a trust written is not something that you really want to go to the cheapest person for. Just keep that in mind. In the matters where the trust document is silent, the trust is governed by the local trust code of the jurisdiction where it has situs. Again, we'll talk about that in a moment. But within the trust code are certain standards of conduct, a duty of loyalty and a duty of prudence. The loyalty means that you need to administer that trust in the best interest of all the beneficiaries. And then for prudence, you need to use good judgment when you're making investments. And if you don't feel like you have that good judgment, talk to some professionals. Get some professional advice on investment management. You have some other duties. We're not going to spend a lot of time on them, but you need to be impartial regarding if there's more than one beneficiary, that you are going to be fair to all the beneficiaries. You're not going to combine the trust property with your personal assets. And then you have the duty to inform and account to the beneficiaries. Give them keep accurate records, file the tax returns and income, other things, and maybe some accountings. Now, I don't expect you to be an expert in reading trust documents. I'm definitely not an expert, but the key things I'd like for you to know from this, from today is There are 7 key features that you want to look for in reading a trust document. And I want to, if there's nothing you take away from today, I want you to make sure you understand one thing. Every trust document has its own purpose. You don't trust, if a person has a trust, they don't have a catch-all trust that covers everything that they are trying to accomplish. Trusts are written to accomplish a purpose. So if you don't read that trust, you don't know what the purpose is. So you do not assume that you know the purpose of the trust unless you read it. So I want to give you some key points to look for. There are 7 parts we're going to talk about, but one of them is more important than anything. The first 3 items are more statement of intent. There should be within the trust document a declaration of intent that I intend to make a trust. The second thing, it's not always there, but if it is, it provides a lot of clarity. What is the purpose of the trust? And I'll be honest with you, in practice, if we don't understand the purpose of the trust, oftentimes as tax practitioners, we will actually ask the client, who drafted this trust, and can we talk to them so that they can explain to us what the purpose of the trust is? And then the third thing is you want to look and determine, is the trust intended to be revocable or irrevocable? Because that's a key feature we're going to talk about later. The next slide is one thing that's you always need to be able to look for and learn how to read is what happens to the property while it's in the trust. Is it, where does the income go? Where is the principal going to go? Who's going to get it? And finally, what happens to the property when you plan for the trust to terminate? Who's going to get the income? Who's going to get the principal? Again, I'm going to refer to principal also as corpus. Principal is like the assets that you would transfer to the trust. And then those assets may have earnings, dividends or interest or other types of earnings, rental income that are allocated. And they can be allocated to different beneficiaries during the term of the trust and also at termination. This is the key feature that you want to have a very good understanding of whenever you read a trust document. And if you don't understand it, then you want to get some help reading it. Last 3 provisions of a trust are more administrative and dealing with certain details. The administrative to make sure that if the trust addresses issues, then you don't have to rely on state law or federal uniform trust code. What happens to the trustee? In other words, is there only one trustee? Are there several? If one needs to leave the trust for whatever reason, how do they get removed or how do they get replaced? And do they get paid? And then finally, the trust document should clarify what jurisdiction it's intended for that trust to be in. For instance, somebody might live in New Jersey, and while they're living in New Jersey, they create a trust. That makes it a New Jersey trust. But if they then move to Virginia, it's still a New Jersey trust. It's still governed by the citizen of New Jersey. So we need to clarify that and understand that. All right, let's start with the code word. Our first code word is inheritance. INHERITANCE, and it is on your screen. Give you a minute to enter that in. It's always useful. Okay. As we're looking over common trust documents, there are some planning considerations that are pretty key that will be more important, especially with Grantor Trust. There are 2 types of taxation involved with estate planning and with income planning. Do you have a large enough estate that you are going to owe estate tax, transfer tax when you die? And then the second thing, of course, is we always need to be aware of what are the income tax implications of a document or a transaction. So some things to be aware of when you're looking at trust documents is, do you have a client, or is this person who's creating this trust wealthy enough that 11.5 or 11 or $12 million per person that they are going to have a taxable estate. If that's so, is their goal to try to move assets out of that taxable estate so that they reduce their estate tax? Many of our clients, that's not an issue. But it's just you need to be aware of whether it is an issue or not. So that's always one of the first questions we ask when people are asking the fiduciary department, all right, will we be dealing with a taxable estate? As a corollary to that is, if you're dealing with a taxable estate, or if you're not dealing with a taxable estate, is it the client's goal to move those assets out of their estate? If they're in their estate, they're going to get stepped up when the person dies. In other words, if you've got stock and you bought it at $50,000, but it's worth $500,000, do you want them to be stepped up so that your heirs don't have to pay capital gains tax on the appreciation of it? That's a big important feature to know. And then the second key point is, how's the income of the trust going to be taxed? And we're going to spend a little more time about that later, but in current tax rate schedules now, there's a much lower threshold for trust income that's taxed at the trust level to be taxed at the maximum rate, 37%, at a much lower rate than it is for an individual. We're going to see more of that in a few minutes. So these are some planning considerations. Do you have any questions yet? Are we doing okay? All right. I'm going to spend in our final slide for the overall trust items. I'm just going to give you just a little bit of information about some common types of trust that we see to let you realize, especially, there are so many types of trust. And I'm sorry that you're having trouble hearing me. I don't have my microphone that I usually use. I was on the West Coast last weekend for Thanksgiving, and an hour before we left, our car was broken into and my microphone was in my bag. So fortunately, they only took my computer and I'm getting that back. Somebody dumped the bag back out and somebody found it, so it's coming back, but I don't have it today. I'm very sorry for the sound. All right, so bypass and Q-tip trust. Usually you're going to see those types of trust as part of an estate or as part of a will. So a lot of those types of trusts that are created are actually created as part of a testamentary trust, and that just means that it's part of the will. Living trusts are very common. We see a lot of them. We're going to spend a lot more time talking about them in a few minutes. Charitable trusts are for clients who want to have charitable want to give away some of their money to qualified charities, and they are either interested in giving away some of the charity during their lifetime and then letting the remainder of the assets go to the family member, or they want to give away do the donating when they die and use the income from whatever the assets are during their lifetime and then have the remainder go to the charity. You see it both ways. Dynasty Trust is a unique feature in that they can avoid transfer tax completely. Basically, for some very wealthy people, they are able to put their assets in a trust. That trust never ends. It's it wanted to be held in perpetuity, and it just crosses the generations, and that way they never pay the transfer tax on it. Special needs, we mentioned a little bit before. If you've got some people in a family member who is vulnerable in one way or another and needs some financial protection. Similarly, there might be some family members who have some irresponsible fiscal behaviors, and we want to either give them time to mature or maybe attempt to provide a safety net if they just tend to be their own worst enemy. And this happens, and so we do see that a fair amount. Life insurance trust also help with the tax and estate planning. Again, these are some more. I'm going to spend 1 minute on the Totten Trust, and this is kind of fun if you think that estate planning is only for the wealthy. You can do a Totten Trust without any documents, without having to pay any money, and it's a valid trust, and it's a wonderful way for people of modest means to ensure that assets go where they want them to go. All you have to do is when you open an account, you can say it's payable on death to a certain person. or you can say it's in trust for a certain person. And that avoids probate, and it lets the asset go to who you want it to go to. So that's called a Totten trust just because of a case that in which it was used. But it's a useful planning feature. Let's move on to what a revocable trust features versus an irrevocable trust, just so that helps us to go into the grantor trust a little more. A revocable trust means basically the grantor can revoke it. They can make changes to it, they can terminate it, they can put assets in it, they can pull assets out of it at any point during their lifetime. And in that case, the assets belong to the grantor the whole time. A revocable trust allows the grantor to also be the trustee. So remember, we had those three components. We have a grantor, a trustee, and a beneficiary. In a revocable trust, the grantor may also be the trustee. They can be their own trustee. For estate planning purposes, it's not considered a completed gift. So there's no gift return, and the assets are going to be in their grantor's estate, which means they get a step up when they die. The purposes of a revocable trust primarily is really to avoid the probate, especially when probate is expensive and time consuming. The income from a revocable trust is taxed to the grantor, the person. We're going to talk about that in a few minutes more because it's a specific type of grantor trust. An irrevocable trust means that the grantor doesn't have the power to change or terminate the trust without going through a lot of trouble. It will require consent of all parties. In contrast to an irrevocable trust, the assets are not owned by the grantor. They are held in a trust, and they are managed by that trustee. In the case of an irrevocable trust, the grantor may not be the trustee. And finally, the funding, when you put assets into that trust, it is considered a completed gift for purposes of estate planning purposes, which means that you need to prepare a gift return. The purpose of a revocable trust are multi, but oftentimes to transfer wealth, reduce taxes, and protect assets. Now, how the assets of the income of a revocable trust are taxed really needs to be clarified by the trust document, which is another reason why you must read the trust document. As we mentioned earlier, you always have to look at the terms. What happens to the income? What happens to the corpus? Trying to get the page to go, and it seems to be. There we go. The unique features of grantors. Now we're going to really focus on grantor trust and how they're different. Grantor trust evolved many years ago, about 50 or so, as a tax strategy. For many years, we were talking earlier about the rates are different now, but for many years, the tax rates for trust were the same as the tax rates for individuals. So wealthy taxpayers were like, oh, here's an opportunity. I make a lot of money and I'm having to pay a lot of tax on it. I'm going to just take these assets and make it where my child, who's in a much lower tax bracket, can have the benefit and they can pay the tax on it because their tax rate's lower. So that was how grantor trust originated. And of course, the IRS was like, well, this seems to be an abuse of the tax rules. However, starting in the 80s and then more in the 90s, they realized that and they drafted laws and changed the tax rate schedule. So for now, the maximum tax rate for an individual is about $500,000. It doesn't kick in until you have taxable income of over $500,000. But for a non-grantor trust with taxable income, your maximum tax rate, that 37% kicks in at $13,000. That's a big difference. But, so you would think, okay, if they've done that, well, then we don't have any more grantor trusts. But that's not true because of course, we've always got people doing creative ways and looking at the tax law, and they've found other ways to accomplish some goals using Grantor Trust. And I'm going to explain how they're able to do that. When we come back to a question we asked earlier, are those assets going to be, that are in that trust, going to be part of the grantor's estate? Again, we're talking about estate and gift transfer tax rules. And then the second question is, how's the income from the tax trust going to be taxed? And that's governed by income tax rules. And you would think the income tax code would be consistent between those two kinds of rules. But there's not. There's some loopholes. And because of those loopholes, that mismatch creates an opportunity for some significant tax planning. And that's why trusts are often rented to be intentionally defective so that they can be treated as a grantor trust for tax purposes, but treated as a unique, a completed gift for estate tax purposes. So when we have a living trust, again, that was that simple document that says, I can put assets in and out of a trust and I can avoid probate when I die. Those living trusts are generally disregarded for income tax purposes, and they're also disregarded for estate tax purposes. But the other grantor trusts that we're going to be looking at today, and there are a lot of types of them, are generally irrevocable trust, which means that they are going to be, they get the assets out of your estate. That's why most of these are done for the wealthy. They aren't all, as we said before, they're not always done for the wealthy, but a lot of these are used by wealthy taxpayers so that they can get those assets out of their taxable estate. But while they're alive, they're going to be disregarded for income tax purposes. And what do we mean by it's disregarded? Well, we'll come back into some more details later, but primarily we are going to tax the income on our income, our personal income tax, because our tax rates are lower than that at the trust tax. So what determines if a trust is a grantor trust? And it all comes down to one key word: control. Who's got control over the assets? If the grantor still has rights or controls over the asset, he's treated as the owner of the trust. Now, the next few slides are in here for reference, but I'm not going to spend a lot of time on them. What I'm simply going to provide is that if the grantor is treated as the owner of any part of the trust, he must include the trust in his own income, the items of the trust, taxable income, deductions, and credits. Those triggers for triggering grantor trust status are in the Internal Revenue Code, section 673 through 679. I'm going to read through them, but we're not going to spend a lot of time on them because I think there's some other areas where we can spend more of our time that's more valuable to us. But this is where it becomes more complicated. Grantor trusts do become complicated pretty quickly. If the grantor has a reversionary interest, in other words, if they say, I'm going to put some items into a trust for a while, and then at the end of the trust, those items are going to come back to me. And the only reason I'm going to put them in trust is that somebody's going to get the income from it for a period of time. That means you've got a reversionary interest. We do see this a lot, especially in estate planning where we've got an elderly parent and we want to do some tax planning. We bought them a house, or they have a house. We want them to be able to live in it, but when they die, it's going to go back to another family member. Section 674 talks about, I can pick and choose who benefits from this trust. That's called beneficial enjoyment. Next section talks about, I have some administrative powers. I can put money into the trust without, I can sell things to the trust at below market value, and that's going to trigger grantor trust status. Another thing that's a key feature is I can substitute property in a trust. In other words, I can originally fund it, but then I can later take that property out and put in another property of equal value. the power to revoke, of course, we talked about that one before. But here's another feature that you do want to be aware of. You don't necessarily, for an irrevocable trust, you do not really want to give features to your spouse, because for grantor trust purposes, your spouse is basically treated as, if you're doing something to benefit your spouse, you're also doing something to benefit you. So your spouse can step into the shoes of you. That's why you don't want to have your spouse be the trustee of a irrevocable grantor trust. And then sometimes there are cases also where the provisions of the trust give control to the person who's going to benefit, and that beneficiary steps into the role of being the owner of the trust. All right. So again, when we looked at our view of the types of trust earlier, I'd like to point out to you that many of those types of trust we talked about are the same types of trust that can be grantor trust. They aren't all grantor trust, but they can be. So there's a lot of ways to use a grantor trust. Our second code word, fiduciary. Right. Spend a little bit of time how tax reporting for grantor trust. As we said, they're basically, for grantor trust, the tax needs to be reported on the owner's income tax return. It's not, a grantor trust means that you're not going to report the trust on a 1041, which is the fiduciary tax return. But if there are times when it does get reported on the 1041, just on that it's all going to pass through to the beneficiary. So it ends up being on a document that flows through to the beneficiary. So the question, one of the big questions is, then if it's a grantor trust, do you need to get an employer ID number? And because a grantor trust is a disregarded entity, it's not required to get an employer ID number while the grantor or the deemed owner is living, unless they're required to file a Form 1041. So the most obvious exception is if that trust is designed to hold subchapter S stock, then it must file a Form 1041, and by default, then it's going to need its own employer ID number. So if it has sub S stock, you definitely are going to need an EIN. That's the official rule. However, in practice, this is what usually happens. If you've got a living trust, most banks understand what a living trust is, and most banks understand that if you've got a living trust, you're going to bring assets in and out of it, and it's okay, and they will let you open that account under your own Social Security number. But in many ways, if it's worded as an irrevocable trust, and obviously when you open a trust with a bank, they're going to want a copy of the trust document. A lot of financial institutions have a policy that if that trust is irrevocable, regardless of whether it's a grantor trust, you're going to need your own EIN. So you're going to see a lot of trusts that have their own EIN, or you're going to have difficulty trying to convince a bank that you don't need one. So be aware of that. It happens in practice. We're quite used to it. So, 1041 would be an optional. You always have the option of using a Form 1041 for a grantor trust, but it's not disclosed the same as it would be if it weren't a grantor trust. And I'll display that for you. If you are using a Form 1041, you're only using it to tell the government, this is a grantor trust, and we're going to put the information on a summary sheet, and we're going to file that with the return. So I'm going to give you an example of that. So if you look, this is what on the left-hand side is a Form 1041, which is the fiduciary income tax return for estates and trusts. And all you do is put the name of the trust and the numbers, the identifying numbers. And on the face of the return, it says, under the terms of the trust instrument, this is a grantor trust. And all the income is taxable to the grantor. And then the right-hand side is a sample of the grantor letter that you would provide. And the grantor letter gives the information that the owner of the trust needs to report on their personal tax return. This is the standard format for a living trust. I mentioned earlier that sometimes the beneficiary might be considered the owner instead of the grantor. And the next example shows what happens if the beneficiary is. What I've done, and I probably made this less clear, but basically instead of it being on page 1, it's actually moved to a footnote. And it just says, under the terms of the trust instrument, this is a grantor trust, and the beneficiary is treated as the owner of the trust. But the net effect is the same. There's a grantor letter that the grantor, the owner of the trust, deemed owner of the trust, uses to report their income. I'm going to, if you don't use Form 1041 and you only have one owner of the trust, the IRS allows you to say, you don't have to do that. You can just report the income on your personal tax return. But you've got to make sure you compile all the information and know that everything is there for you to file so that you don't miss any of that trust income. So in order to do that, optional method 1 is available. And what the trustee has the duty, in this case, to provide to the payers of income the grantor's name. And I would say, to avoid confusion, go ahead and make sure they know you're giving them their social security number because they are the grantor of that trust. So in other words, you give to your broker the grantor's name, social security number, and then the trustee's address. In other words, the trustee is supposed to compile this information and then give it in a compiled form to the grantor so that they can include it on their tax return. The next 2 methods I don't recommend. They are 2 included methods that the IRS says you can do. And basically, what happens is the trustee, instead of letting the payers just issue the 1099s, the trustee collects all the 1099s and then does a second set of 1099s directly for the owner. I've never seen us recommend that this happen. So it's in there, be aware of it. We don't recommend it. Same thing if there's more than one owner, that would be optional method 3. All right, we have a third word, which is control. And I'd like to kind of spend a little bit of time about what almost happened. Back in October, these were some of the things that Congress was contemplating. As we said, there's a mismatch between what the rules are for and which creates the opportunity for grantor trust to exist. And Congress spent some time drafting some legislation that basically would have made grantor trust be a thing of the past. Basically, they were saying you could treat all the assets in a grantor trust as a completed gift, even if it was irrevocable, which would mean that you would not get that there would be a step up. But also that you would not get it out of your estate. If you have to include it in your estate, then you just remove the assets. I'm sorry, you've made it taxable, subject to transfer tax. These are some of the other features. And you would also have the opportunity, if the grantor turns off the grantor trust power, that would constitute an additional gift, which would require more gift returns. Distributions from the trust to the beneficiary other than the spouse would be treated as a taxable gift. So a lot of features they were talking about, and what happened is in the most recent version, they have removed that. But we don't know whether they're going to readdress it or whether it's going to come back to haunt us. I would like to talk about, if you want to understand more about trust and how they work, there are 3 good resources that I recommend. The PPC 1041 desk book, and those of us in our office, you have access to Checkpoint, and this desk book should be available in Checkpoint. It is a very useful reference for the taxation of trust. In Wolters Kluwer CCH, there's a CPE link, self-study CPE called Trust Fundamentals. I think it's a very good primer for tax practitioners. And then the Estate and Trust primer that's part of the AICPA Tax Statute Essentials Level 3. All 3 of those I think are very useful, and I would recommend if you want to have some more information on them. I would like to open up if there are some questions about how trust work and if we have any practical examples. This is a pretty quick way of going through it, and I think there's some opportunities if you need some information. I would like to know out there, have any of you had experience doing one of these? I'm going back to the 1041. Hearing none, I'm going to go back to this other screen as well, some of the common types of trust. Medicaid asset protection also is one that's useful not just for the wealthy. It's a way to, especially if you've got family members who want to stay in their residence, but they may be qualifying for some Medicaid aid, or could Medicaid aid, but you want them to be able, once they've passed on, if you want them to be, if you want to be able to sell their home and retain the gain exclusion. The Medicaid Asset Protection Trust is a planning tool for that might be worth looking into. Life insurance is used a lot of times in putting premiums into the paying the premiums of the life insurance policy through your estate, through the trust, and the benefits from those life insurance proceeds can be used to go to the next generation. As we were talking about the charitable trust, I'm going to spend a few minutes on those now that we've got a little bit of extra time. Just want to let you know. Charitable League Trust is where you're putting the, they've got Charitable League Unit Trust and Charitable Remainder Unit Trust. And I was talking about that earlier. The Charitable Lead means the leading portion, the income each year goes to the charity. And Charitable Remainder Trust means that what's left after you die will go to charity. And what happens a lot of times in the charitable remainder is a family member gets the income during the terms of the trust. go back to the resources. And if that is, if we don't have any other questions, then I want to let you, thank you for being here today. I hope this-
Terry has a question, Celia.
Oh, good. Do I explain a Q-tip, qualified terminal interest property trust? Thank you. Q-tip trust is where you are putting money into a trust, when it's often used in a husband and wife, and then you want to put money into a trust that's going to go to someone else, to the rest of the other family members. It's used for family planning a lot of times. So what it means is when a spouse dies, usually this is used for the spouse of whichever spouse dies first, their trust document then through their will creates a trust where you've got a qualified terminal interest trust, and during that spouse's lifetime, the spouse is going to get the income from the trust. But when that spouse dies, then the assets are going to go to the rest of the family. And it provides some measure of security for the family member, for the spouse, while that spouse is widowed. And then when the surviving spouse dies, then someone else is going to get it. And this can also be used when there's a second marriage, especially. In other words, it's going to be used by the spouse until that spouse dies, but maybe there are children from a different marriage, and it could be different beneficiaries who are going to get it. Thank you for that question. Substitution slide? Okay, let me see if I can find that. Okay. Substitution file. Powers. We see this in, they have to be really careful if they substitute powers. And then we see this a lot in intentionally defective Grantor Trust. That's a trigger that a lot of people want to have, a lot of attorneys will use. That you can take a property of equal value. Let's say that you've got property that you expect it to appreciate in value, and then it ends up not appreciating in value, so it's not going to accomplish the goals that you want it to do. Then you could definitely reacquire it and then substitute something of different value, but it has to be of equal value of what went into the trust originally. All right, everyone. Thank you very much for being here, and I hope you enjoyed the next session. We've got one more to go, and then we've had a nice, good day of tax update.